Hello and welcome all to our keynote presentation of featuring John Yankee and Michael Drosh. And John is with Tackle.io. And John was an early investor and advisor in Tackle, and now he serves as the CEO. He has spent 20 years in executive leadership roles with B2B technology companies like Pivotal, Greenplum, EMC, and Cognizant. John is passionate about remote work and helping software companies with their go-to-market strategy. He leads Tackle from Buffalo, New York, where he lives with his wife and 3 children. John, welcome.
Thanks, Adana.
Take it away.
Excited to be here. Awesome. All right. Hey, everybody. Great. Thanks for joining. Look forward to this chat and excited to kick off Buffalo Startup Week. And I'm pleased to introduce Mike Drosh from Bessemer Venture Partners. And Mike, maybe you can say a little bit about yourself.
Yeah, I'll just give a very quick intro. I'm an investor at Bessemer, and across the last 4 years, investing in a variety of B2B software companies and also B2B marketplaces, and have had the pleasure of now investing in 2 companies in Buffalo since I had the pleasure of being associated with ACV Auctions in Buffalo, and then recently with Tackle.
Awesome. Appreciate you joining, Mike. And so the structure of this talk, it's set up, so like many startup people, I have a short attention span. So it's set up to kind of mimic the way I would want to be talked to in this type of setting. So we've broken it into 4 sections, and those 4 sections are really 1 about defining terms, 2 about the nail it phase of a startup, 3 about the scale it phase, and then 4, the what about Buffalo phase. And in each of those, we're going to break out and do a small fireside chat where I'll pose a question to Mike as an investor from Bessemer and just get his perspective on each of those topics. So we'll dive into it. I will start sharing. And while I'm sharing my screen, if you have questions, please fire them into the chat and we will attempt to answer them along the way. And if we don't get to answer them along the way, we will try to be done in time to do questions at the end. All right, cool. Mike, can I have a thumbs up can you see? Awesome. All right, cool in the game. Okay, so a bit of backstory. Tackle is from the B-Towns of Cloud, so Boise, Idaho, and Buffalo, New York. Founders of Tackle are in Boise. We all worked together in the past at a big data analytics startup called Greenplum, and we're remote first, so remote for the win. We were founded in 2016. The team has grown from 6 at the end of 2019 to 52 people today. And actually, sorry, 6 at the end of 2018 to 52 people today. That would have been a even steeper growth curve. We've all spent our history in B2B tech, and we've spent a ton of time. All those companies were either based out of Boston or New York or San Francisco, and we spent a ton of time on airplanes, which was less than desirable. And a lot of those companies followed this grow at any cost pattern, which never really made sense to all of us. We just didn't understand that kind of spend just to grow in a really inefficient way. From a capital standpoint, we did a seed round in 2017, and then we did a convertible note through 18 and 19, and then we raised our Series A, led by Bessemer, at the middle of 2020. And this is not necessarily a story of Tackle. This is a story of everything we've learned along the way to try to weave capital efficiency and hypergrowth together. So first thing we're going to do is try to define some terms. And it's funny to me that in the definition of definition, it says the exact meaning, because I think exactness is not something that often shows up in early stage startups. So traditional startups of the past, like I think this picture, the burning the boats picture, is something I think you've heard a lot, when you were going all in on a startup in the early days. And this idea was, a lot of times it was a pretty high barrier of entry to start a company. You had to invest a lot up front. And if you didn't have the either experience leading and running a successful company or a really, really compelling idea, it was hard to get money to get started. And it was this perception of all or nothing. I think it's pretty common for people to think like startups will either succeed or fail. It's a 1 in 100 or 1 in 10 or 1 in 1,000. And a lot of times these companies of the past got caught in a venture cycle because they were spending so much money to try to grow and try to build their product that they'd run out of money, they'd need to raise more money, and then they couldn't grow efficiently. So they just get stuck in this cycle of venture. And I think, capital efficient startups, and the picture on the right is from the movie Miracle, if you haven't seen it, but they talk about opening up the offense and defense to have options. And they had to play a different game to beat the Russians in 1980. And I think capital efficient startups are a different game today. And the barrier to entry for startups is lower than it's ever been from a cost of infrastructure standpoint, powered by the cloud. Technologies like serverless give you the ability to build things for less money than ever in the past. And capital efficient means you have to start small, you have to focus on a persona, you have to ruthlessly prioritize what you're building for who and how they will consume it. But it doesn't necessarily mean that you're not well capitalized. So first definition, capital efficient startups. So when we started in 2016, we had this idea of capital efficiency, but there was very little actually published about how to build a capital efficient company. And I'm a student of SaaS and B2B tech, and I spent a ton of time reading this article from Dave Cummings, which was actually published in 2012, was something that spoke to me. And it was like, hey, how do you get to $1 million in ARR with $1 million of capital? And I'll share this deck in the Western New York community Slack channel after this, so don't try to take notes, or you'll find those links in that share. If you're not part of that, Google those terms and you'll find the link to sign up. But that was a really compelling article. But just recently, I found this burn multiple article, which was published in April of 2020 by David Sachs, who's an investor. And it just talks about taking your total ARR and net burn divided by net new ARR and getting a score as a way to measure your capital efficiency. And this really works at any phase in your life cycle, whether it's lifetime burn or monthly burn or quarterly burn against your ARR growth. And it's a really pretty amazing way just to kind of keep track of your capital efficiency. And a score under 1 means you burned less than $1 to get $1 of ARR is amazing. And I think as we were building Tackle, we always looked at what does world-class look like, and is that possible? And this is one of those things. I look at this chart on the right from this burn multiple article, and it gives you a kind of a target for what world-class looks like. And then the last thing is efficient unit economics, and CAC and LTV, if you're in the SaaS world, those are terms you've come across. In early stage, it's really, really hard to measure those things. And honestly, you can spend a lot of time trying to figure out how to do that too early. And I personally struggled with this because I wanted the numbers, but I couldn't get there, and I didn't have a team around me to support that process. But just think about it as efficiency. Like, how do you acquire customers efficiently? How do you make sure those customers are getting value out of your products? And if you use that efficiency mindset, you can kind of grow into actually calculating your CAC and LTV. So, and this was a tweet from Jeff Lewis, an investor at Battery Ventures, and I thought it was just such a great summary. Like, people always talk about your burn rate or your monthly burn rate. That kind of point in time is valuable, but when you look at it as the total burn, total lifetime burn, that's literally the video of your company. So what do you all want your video to look like? So hypergrowth, and we're going to break for our fireside chat in like 2 minutes because this is way too much of a monologue. Hypergrowth, originally this term was published in 2008 by the Harvard Business Review, and it talked about the steep part of the growth curve and really was measured off this 40% compounded annual growth rate. And I think 40% is an amazing thing, but if you think about some of these other models we see at the bottom, like the triple, double, 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 besides being fun to say, it's actually a pretty compelling growth model, or the GitLab WOW model. Those are designed with how can you build $1 billion valued company in pretty short cycle. And in both those models, it's measured in about 6 years. If you took this 40% year-over-year growth curve and say you got to 2 million in ARR in year 1, it'd take you 13 years to build a $100 million ARR company. So what's changed is the expectations around what hypergrowth looks like, especially when you're thinking about a venture-backed startup. So Couple examples, T2D3 sounds like a droid, but some companies in here, ServiceNow or Salesforce, and how they mapped against the T2D3 model. If you've never read this, it's a great read, and I encourage everyone to take a peek. Really the math, like the math implies, okay, how do you get your company to 2 million in ARR? And then how do you rapidly grow that company? In T3D or T2D3, you're tripling the 2 years after. So you get to 2 million ARR as fast as possible. Then you go from 2 to 6, 6 to 18, and then you settle into 100% growth after that. In the WOW model, it's a little different in that kind of flattens out some of that mid-stage growth, because if you've tried to build a company that fast, going from 6 to 18 is really fast and requires a lot from an infrastructure standpoint. So, Sid's prediction was it was a little easier to slow down in that early stage and go faster a little later because you'd have more infrastructure to support that. So, all right, we've defined the terms. It's time to actually get some insight on those. So, Mike, as you hear me ramble on about capital efficiency and hypergrowth, how do you think about this? How do you prioritize them as an investor?
Yeah, I'm happy to chat about it. So I think the first thing I want to just preface my comments with is, I'm specifically speaking as a VC investor at a large fund where we are really only looking for the companies like the ones that John has outlined there, the ones that are really on this path to potentially have a shot at a $1 billion outcome. And that doesn't mean that companies that aren't on that path aren't also great businesses for all of the early stage investors and founders and all that stuff. But specifically with this lens on the types of companies that we're looking for, I think admittedly in the early days, kind of seed Series A stage, we are looking for growth over efficiency. We need some baseline level of efficiency, which we definitely think about. We're looking more for the companies that are just on that kind of high growth trajectory. That being said, though, as companies get more and more mature, the whole model kind of flips on itself. Above, say, $50 million of revenue, investors start to look more for some base level of growth and really value it on efficiency. So at some point, that formula flips. And this is all under the pretense that you can't have both at the same time. Because that's just extremely difficult. But every once in a while, you find these high growth companies that are also extremely capital efficient. And honestly, when we see that's like the holy grail combination. That's the thing that really gets us excited, because I think the efficiency, if the combination of efficiency and growth just at least signals to an investor that one, the team is executing really well. They have a clear plan and they're doing everything that they can to execute against that. And that they've got both product market fit to some extent, like clearly this is a product that the market wants, and generally they have more than product market fit. They have like extreme product market fit. The market is pulling the product out of the company. They've got some sort of distribution hack that is allowing them to be so efficient. So those are things like like referrals and customers just speaking about you virally. Those things make it a little bit easier to build a really efficient business when you don't have to spend as much on sales. So when we do see both of those things, I think that's a really exciting time for us.
Awesome. Yeah, I think Mike's point is right. These two things are rare to go together, and I'll talk about this later on in the deck. I think setting goals around hyper growth and capital efficiency is really hard to do, especially as an early stage company. But what you can do is set some intentions to say, we really want to try to be a hyper growth company. We really want to try to be a capital efficiency company and capital efficient company. And I think it's amazing how powerful setting your intentions can be to driving your outcomes. So while these things are often rare, I would encourage you not to think about them as impossible.
And John, I might just add that even in that, you don't have to necessarily decide we're going to be in hyper growth mode from founding day one. I think lots of companies are very efficient until I think where you're going with this, which is like until we've got something that we really think could hit hyper growth, and it would make sense to take on the money. You don't have to only be in one mode for the company's entire lifetime.
Absolutely. I think that's a great lead into this nail it phase. So, and I will come back. I can't see Q&A while we're talking, but next time we fireside chat, I'll pause and we'll check the Q&A. Okay, so on the nail it phase, and this ties right into what Mike said. So what kind of market are you attempting to enter as a company? And this is a combination of a few different concepts. So the link at the bottom that talks about a bottoms up SaaS company implies that, today more than ever, every business process that was powered by humans and an Excel spreadsheet could effectively be $1 billion SaaS company today. And more buyers are getting comfortable with the fact that they as individuals can buy solutions pretty efficiently that help them do their job better than not having those solutions or trying to build them themselves. And you kind of have the capital requirement on the left-hand side. On the bottom, we have time required. And then the cross in the middle is really like that bottoms up motion versus a top down motion. Bottoms up would be user discovered, user consumed. In the middle, the MVP on the left-hand side is, you're building a product where likely it's something new or there's not a lot of competition. On the right-hand side, it's in order to enter a market, you have to build a full feature product where there could be lots of entrenched competitors. So when you're in this upper right-hand quadrant of this, that's where it's extremely hard to start in a capital efficient way. And the best example recently of this is Zoom. You look at when Zoom was founded, Eric started Zoom and hired 40 engineers to go build a better product than WebEx. That's not something you can do without a fair amount of capital. Even Snowflake was incubated with a pretty heavy technical team at founding, because to build out the cloud data warehouse, they knew they had to invest heavily in technology to go disrupt entrenched competitors. But at the bottom end of the scale, when you're coming up with a new way of doing things, it is really possible to get to a product that's viable for your buyer that delivers value in much shorter cycle or much higher levels of efficiency. So this map for me helped crystallize like what kind of idea do you have? What kind of company are you trying to build? And are these premises even possible in the space that you're operating? So the second piece of the nail it phase is all around this idea of repeatability. And I think for a lot of early stage founders, early stage companies, you have an idea, you have a problem, and you're really trying to find who are our users going to be. And one of the mistakes you see a lot of companies make is they go win their first customer, they win their second customer, they win their third customer. And all three of those customers are a bit like a snowflake. They kind of all have slightly different shapes and sizes. They may be all similar. And once you commit to a customer, it's really hard to let them go. Or, you commit to building something for them. It's hard to say, well, we're no longer going to do that because we're going to focus over here. So I think in the earliest days, this is kind of made up just based upon the journey that Tackle went on. It needs some sort of fancy name. We'll just call it the efficiency and repeatability cycle right now. Kind of has a lot of foundation in the build, measure, learn from Eric Ries on the Lean Startup. But what is your product? Who's going to build it? Who are they building it for? And why will they buy it? Who's going to sell it to people? And then how do you make them happy? And in the earliest days of a company, it's possible to go through this cycle potentially with a single employee. Like in the instance of Tackle, Dylan Woods, our founder and CTO, had a product, went through this cycle on his own. And he had some outside support. I actually was on the board. Brian Denker, co-founder, actually joined a little later after we got further into this product market fit cycle. But it's possible to break that cycle down to as small as one employee. Or if you have a founding team, it's possible to break down everything that's on the slide into that founding team so you can divide and conquer your way through that journey. There's a ton of content here, and I'm not going to go through it all, but I think a couple things that are really key to me are, one, how are you going to be 10 times better? And that could be 10 times better than the alternative, which is someone doing it in a spreadsheet or doing it themselves or building it themselves, or 10 times better than the competitors or the alternative. You need a clear value prop on why. The second piece, I think, is this idea of the ideal customer profile. And this ties into repeatability. And a lot of times, I think, startup founders are so desperate for products to get used, they'll welcome usage in any flavor or form. But that actually can be dangerous because I was amazed at how influenced our product strategy was by our first customer, and how to this day, their usage as the ideal customer profile influences a lot of what we continue to do for our customers. And frankly, this in a lot of ways was luck for Tackle. And in Tackle's instance, we help software companies sell through cloud marketplaces. Our first Lighthouse customer was New Relic, who's a big SaaS company and was struggling with what we were trying to accomplish, shared the same vision around the clouds being able to disrupt the way software was sold and bought. And they went on a journey with us. And when they started with us, we had one employee. Dylan was the only employee, and we had some people kind of on the board and supporting as advisors, helping along the way. We had done some work for others at that time, but that work was more experimental in nature. And fortunately, we didn't actually get to selling the product that we thought would become the company until that first customer. So that ideal customer profile is really important. And then the last piece is this idea of customer chapters. Like, the chapter of the story for customer 1's different than for 2 to 10, different than from 10 to 50, different from 50 to 100. And by breaking it down into some sort of customer journey like that, you can make things a lot more digestible. All right, fireside chat number 2. Mike, when you meet companies that are early but seem like they're on an interesting track, what are you evaluating?
Yeah, so I'll take this to mean, assuming we're talking kind of $1 million or less of revenue, really kind of still in this first first handful of customers discovery phase. Because beyond a certain scale, there's a lot more numbers, there's a lot more data and history, and it becomes a little bit more of an analytical exercise. But in these early days, I think the companies that we meet that seem like they have something interesting going on, but it's a little bit harder to kind of quantify as an outsider coming in. But I think the things that we look at are all the typical things that you've all heard. We look at the team and the market opportunity, particularly like any large trends that are changing that market opportunity quickly. But the things that probably get us most excited in the absence of just unbelievable data and performance would be, one, what John spoke to is like, does the product have a fundamental advantage? Or does the company have a fundamental distribution advantage? I think that's sometimes the other interesting way that you could like come at a market with a somewhat similar product from a feature set perspective, but you've got some sort of viral distribution, or you've got a freemium offering that just allows you to dramatically undercut others and grow much faster. So those are the things that I think we're looking for. Like, do you really have some leg up that we believe could scale over time? And the other strong signal, I think, for, in the absence of lots of large customers, would just be the customers that you do have. How engaged are they? How do they talk about your product? Are they just raving? Are they like fanatical about it, telling other people? If some people call them to ask them about it, are they like the biggest fans in the world? That speaks volumes. Certainly having brand name customers to some extent always helps. It's not a must, but I think having, the New Relics of the world, or a big kind of brand name buyer who's sophisticated, definitely carries a lot of weight. And then maybe the last thing I'd say is just some sort of fundamental unit economics. And this is probably before you've gotten to the point, like John was saying earlier, where you clearly know what your CAC and LTV are, because you've only got 1 or 2 customers and you haven't even had them for a year. So who knows, what your churn and long-term customer lifetime will look like. But in the early days, like, you should be able to have a sense of how expensive is this customer to support. Out of my time as the 1 or 2 founders, how much time am I, spending with fielding customer support tickets? How much time, how long was the cycle to get them onboarded and stuff like that? Will obviously all get better with scale, but if your first 1 or 2 customers are reasonably efficient, the product kind of serves itself, you get reasonable margins on it, that's also a good sign that investors could extrapolate forward and imagine that this is going to be a reasonably efficient business as it continues to scale.
Awesome. That's great. Thanks, Mike. All right, so kind of pivoting into phase 3, and if anybody has questions, fire them into the chat as we go. So let me reshare my screen. Okay, so scale it phase. So I think in this theme, along this theme of capital efficiency and hypergrowth, as you start to enter scale, this is where the getting to an initial scale phase efficiently is where I think you can really set yourself up for success. But there's no doubt as you start to pivot into some level of scaling from a selling standpoint, you're going to have to grow, and you're going to have to very likely grow the team to support the business. And this, really, we've talked a lot about repeatability, and that repeatability from a product standpoint. Who's your first customer? Would that value prop apply to other customers as you start to move through those customer chapters? Will they use it? Will they pay for it? And I think different business models can have different answers to those questions. But really, once that wheel is turning, the scale component really comes down to your ability to build a team. And I think this is an area that I hear, I think a lot of, especially engineering-led teams, get very focused on the product and focusing all in on the product. But, along that efficiency cycle that we talked about, you have product, you have how you're going to sell it, and then how you're going to delight your customers. And typically an organization is broken down in some way along those 3 lines. So repeatability and then getting a team to execute on that repeatability is really key to that first phase of initial scale. So, start small, think big, scale fast. And using lean startup principles, just, that build, measure, learn cycle. And then how do you apply that to a company? How do you apply that to a team? How do you apply that to an individual or a pair of founders who are starting to go on a journey? And for us, we always tried to operate, bigger than we were. Even in some of our earliest days, we would try to take the vision of an organization we would build and then break that down amongst us. And the 3 key components: product, sales, customer success. In a SaaS company, we would say, okay, as a small team of 4, how do we divide those functions up? And then, we maybe layered on marketing slightly later, but what are the core functions of the company and who's doing what? And just being really transparent about who is the owner of each of those functions. And there can be some overlap. There's no doubt going to be this instance of a lot of people doing a lot of things in an early stage company, but be really honest with yourselves around where your strengths and weaknesses are and how you can ensure that you can replicate the organization that you want to build, even in the earliest days when the team may not be big enough to do that. From there, I think once you define your short-term goals and are starting to execute and moving towards, I think $1 million in ARR was a big milestone for us in those early days. Like, how do we get to $1 million in ARR? How many customers would that take? How many ideal customer profile companies are out there? How can we get to them? And, charting that course, it really became, what was the plan to recruit, attract, and hire talent in order to help us go on that journey. Because if you find your path to a reasonable problem and a solution that's efficient and well engineered, you very well may find demand exceeding supply from a team standpoint, and then being able to build a team rapidly to capture that demand will become the next biggest problem for you. So we broke our journey into this organizational MVP concept, and I talked about some of these thoughts in the last slide, but it was really that founding team, strengths and weaknesses. And for us, our original team was 2 + 2. It was 2 founders and 2 employees. I was employee number, we had our second engineer as our 3rd employee, and I was employee number 4. And we broke down product, sales, and customer success and marketing amongst the 4 of us. And it didn't mean like each individual had one of those functions. It meant the 4 of us had to accomplish those 4 things together. And from there, we set some goals. It was like, okay, can we get to 20 customers with that initial team? And we very rapidly figured out we did not have enough support in customer success. So for us, the very first place we invested, our next 2 employees came in customer success, because the repeatability and the ability to invest in making customers successful was really critical to our long-term journey. And then from there, we started to say, okay, how would we break this down based upon the chapters of the company? If our next milestone is 50 customers and $1 million in ARR, what does the company organization need to look like at that point? And then our next milestone from there is 2.5 in ARR. What's the organization need to look like? And just by aligning our organization design with our ARR and customer goals, it made the investment prioritization really, really easy, because we could see where we were making progress and where we weren't, and where we would invest based upon the signals we were seeing from our customers. All right, so fireside chat number 3, like founding teams, challenges. I think like this transition, we've kind of moved from initial product and getting to product market fit to initial scale. I think that's an area a lot of people struggle with. And Mike, what are some of the struggles you see that are common and ways people can overcome those?
Yeah, I think most of my thoughts when you guys talk about this come to the team and people, challenges, as I think you've alluded to here. I mean, the number one for most of these companies is either figuring out how to hire the right folks, but also getting comfortable giving up responsibility for things that the founders owned initially. And I think this is something we see a lot with certainly with technical founders when it comes to product and trying to distribute responsibility for engineering and product management. It can be really challenging for somebody who birthed this idea and product out of nothing, and has always been, a kind of core bottleneck in ensuring that the product quality is what they want it to be, to suddenly give up a little bit more of that responsibility and distribute some of that decision-making power to other people. But that is, that's kind of an important early step for any company that's really distributing, decision-making beyond the founding team. And then I think the other piece here is we do see, I would say most often when we invest at a seed or a Series A company, and this is certainly not true all of the time, and has not been the case at Tackle, but in many companies we join and maybe we've got 1 or 2 people on the team who have been there and they have some sort of kind of relevant prior experience in the industry or at a company of this scale. But oftentimes a big task in that first year or 2 is how can we add other people? Who else do we need to add to the team to help complement the existing team and help them scale up with all the other experiences that that they need? Because as anyone who's going through this right now knows, like founding a company is an effort in constantly developing new skills and trying to come up learning curve as fast as possible. But that only works to a certain extent. At some point, you need to bring in folks that also have deep expertise in specific domains to complement you. So I think I echo that one a ton. Maybe the 1 or 2 other thoughts that I have were, as companies scale up a little bit more, maybe beyond that first $1 million revenue, sometimes parting ways with early customers that either aren't, you kind of evolve your ideal customer profile and realize like, oh, these first couple customers, they were great when we needed somebody to test the product on, but they actually have an odd use case. They're very services heavy. It's, whatever it might be. That's one case. Or frankly, just we decide we need to move up market a little bit more, and we signed on a bunch of smaller customers in the early days, but we're going to kind of increase the price over time, and they may not be the ideal customers for us to serve anymore because they're high churn or something like that. They're not as worthwhile. So those are just like natural evolutions that I think we see. And then the last thing that we see some companies see is just your perspective for what feels like a big company and a high amount of revenue changes very rapidly when you're in this high growth, hyper growth journey. You go from being like a handful of folks at less than $1 million of revenue, you hit $1 million, that sounds like a huge number. And next thing you know, you've got 50 people and a lot more revenue. And so sometimes I do think it can be helpful to get perspective from outsiders, just to get a sense of like, are we being aggressive enough? Is this, it feels like we're this huge company now relative to where we were, and having somebody else come in to maybe encourage you that things look like they're going on the right path, and actually maybe there's an opportunity to double down, and you're still in just the very early days. So I always think it's helpful to get outsiders' perspectives on things like that.
Yeah, I think that is such a great point. And I mean, something we, again, almost the accidents along the way, the things you learn, Brian and Dylan were thoughtful and had been in startup journeys for a long time, but they knew they wanted to build kind of a group around them in the early days that could go on the journey with them, and really with complementary skills. So they built a board early. We actually had a 5-person board when we only had 2 people actually working at the company, which sounds unusual, but the makeup of that board was, Silicon Valley CFO type, because frankly, that finance and operations, getting a company set up, building a stock option program, the right legal documentation to do contracts, the right partner from a legal standpoint, were areas that the team didn't have a lot of expertise. So they're like, oh, that's something we need to pull into the board. Or even someone more with a strategic product mind, with an eye on investors, and kind of some insight as to what it would take to raise capital. So that getting help early, getting outside perspective, I do think super valuable. And I think I also found these growth models, and just what does good look like in the industry, what's world class, and is that even possible? Always a great outside perspective. So we did have a question come in, and let's see if do you have any suggestions of books that help founders build a team and have trust in their teams? So I have a couple I'll rattle off, Mike, and give you a second to think. So $1 Trillion Coach, I think, is a really, really great one. It's about Bill Campbell, who's this legendary kind of Silicon Valley coach. He was a coach to Steve Jobs at Apple. He was the coach to the founders at Google and the executive leadership team at Google. And a lot of his companies added up to $1 trillion market cap. He passed away a few years ago, but that was a really great book. Just as you think about setting goals and kind of coaching your team. Another one that always spoke to me was the idea of servant leadership. And there's a lot of different books published on servant leadership. And, for me, especially in startups, leaders have to be people who do, and you're there to serve your team. And that philosophy always really spoke to me. And then one I read recently was Measure What Matters by John Doerr, who's a investor from Kleiner Perkins, which is all about the philosophy of OKRs and goal setting in a high growth company, and driving alignment with a team, especially as it scale. It's kind of been important for us at Tackle as we've gone from 25 to 50 this year, thinking about implementing OKRs. What about you, Mike?
No, I think you're definitely more qualified to speak on this than me. I completely agree with Measure What Matters, and I'd maybe highlight just some of the classics. Like Good to Great for me is still is a great exercise in what does really high quality management look like at some of the largest companies, the most successful companies in history. Yeah, I would, and I think your list carries it pretty well.
All right, cool. All right, so the last phase of our chat. Okay, so I always like to go back to the dictionary definition of things. Webster says intention is determination to act in a certain way, and I think as we've said a few times on this journey that hyper growth and capital efficiency aren't something you can say that's what we're doing. We're building that kind of company, but what you can do is set your intention. And I think that the earlier you decide what kind of company do you want to try to be, and try to start to build your plans to measure and iterate and evolve in that direction, the higher the likelihood your success will be. And I think, another piece, just as I reflect on our journey at Tackle, and I didn't want this to be a Tackle story or the history of Tackle. I really wanted this just to be a collection of reflections, because for us to get where we got to, we set out with these intentions almost unknowingly, like capital efficiency was an intention. We always wanted to be a growth company because just growing up in B2B tech, you don't know any other way. But you don't necessarily know how to get there. And it is unbelievably powerful when you get customers to give you feedback and making your company and your culture, and customer obsession is almost cliche at this point, with, Amazon kind of beating that drum for a long time. And I think every company starts often with that customer obsession top of mind, but really customer obsession is so much more. It's what you do with the feedback from your customers, and your customers will help you write your story. And the sooner you can get them something that delivers them value, the faster you will have them helping you go on a journey to writing your company story. All right, so what about Buffalo? What about Buffalo this weekend? So why Buffalo? I think, this is something, as we round out kind of this talk and hopefully open up for Q&A. It's so funny. I've always worked in these big cities for companies, and the reaction to Buffalo is always the same. Like, Buffalo, I'm like, ugh, why would you want to live there? It doesn't snow all the time. Isn't it 40 degrees in August? And it just always confused me. Like sorry, lost my screen. Can you hear me still, Mike?
Yeah, we can still hear you.
Okay, I'm unable to restart my video, so we'll just keep rolling, and then we'll figure that out as we go. So why would someplace I love so dearly, why would people from the outside not want to embrace that? And over the years, I've just given up on that fact and have come to acknowledge that this is a really special place. And I think over time, people will discover that in their own way. And for me, it's about like family, four-season lifestyle, a city with space, and so much is only 20 minutes away. Where else could you be in the country and in the city, both in 20 minutes from a lot of parts of this community? And I think remote work, tier 2 cities are going to rise through this remote work era, because just everything that you can get, whether that's the quality of the workforce, the talent that's available, and even the cost of living, I think position a place like Buffalo really to rise. And then, I mean, as I think we're remote first, so we have team members in 28 states at this point. But I love the mindset of this area, just with the city of good neighbors. And I think as everyone on this call thinks about building a company and building a startup, the city of good neighbors as a foundation for your company. I can't really think of a better way. And amazingly, we have video back. Okay, so Buffalo on the rise. What can we do to improve? And let me move my video to. So a couple things. I think first and foremost, and this is starting to change, but the confidence in Buffalo, like the feeling that this was a place where we could build billion-dollar valued companies and build high-growth startups and build tech companies. A few years ago, that wasn't the case. And, give a lot of credit to those who've come before us, especially the team at ACV, pioneering their way to, the first billion-dollar valued startup out of Buffalo. And, the ecosystem, and, I try to be an active participant in the Western New York community Slack channel, and just seeing that grow from nothing to almost 1,500 members as it is today. Everyone on this call should have the confidence that you can build amazing things from here. And if you don't, reach out to the community around you, the city of good neighbors, to help you, because there's lots of people around to help. Number two, this is more of a call out to the broader business community. And one of the things, especially in tech, this tends to be a late adopter community. And if you're part of the local established business community and you want to help the startup community, what can you do to become a customer of a startup in the local community? Because, revenue solves all business problems. Every startup is looking for their next customer, and, the business community here has an opportunity to help. And that's really, I think, becoming customers of companies established locally can be really powerful. And I would challenge founders, don't think local from a customer standpoint, be realistic, define your ideal customer profile and go find it. Like if it's not here, don't be scared of that. Like you can build a great company from anywhere. I think on the talent side, you know, we have amazing local talent, and we definitely run into some gaps in the strategic middle, people who've been there, done that, and done hyper growth or done capital efficient growth. Don't be afraid to think of remote distributed teams. You can build great teams that are anchored here, but still have support from outside. And I think the world as it exists today, it could not be set up better for remote companies or hybrid companies to continue to scale. And then the last thing, kind of the call out to the broader community, you know, Buffalo's small. Buffalo, Rochester, Syracuse, Albany, you know, sometimes I think we try to make ourselves bigger than we are individually, when in reality we should just unite into one bigger community. And I love what the Upstate Venture Connect crew has done to help, you know, at least myself connect to other leaders across the kind of 4 major cities in New York State outside of New York City. And, you know, I think we have to all think about building that connective tissue with the broader region. So Mike, Bessemer's invested in a few companies in Buffalo now. Like, what's your take on the startup market here? What advice do you have for founders, future founders, about the community?
Yeah, well, I gotta say we've been very, you know, very happy investors in Buffalo, both with ACV and Tackle. It's just been a phenomenal experience in both cases. I think the things that stand out to me, you know, it's everything that I think you had touched on, John, you know, from the efficiency to the just like super good, hardworking, humble people all around, like City of Good Neighbors, which you shared with me recently. I feel like that captures it well. It's an awesome slogan and mindset to have. And then I think, honestly, some of the things that surprised me, which is like, you know, I know when we first got involved with ACV, and one of the questions that this is just like to give you a sense of the types of questions that an investor partnership might ask when we would bring a company like this to present. They say, well, like, if we're going to build $1 billion company here, how do we attract enough you know, software development talent to support a company like that to Buffalo? They'll have to open a second office. That was, you know, something that came up a lot in our very early days, but when we made that investment. And I mean, that's just been something we've been really pleasantly surprised by. Not only how much engineering talent currently exists in the Buffalo ecosystem, which I think, you know, a lot of people might not be aware of, but also how strong the pull is back to Buffalo. Like, I couldn't believe, even before ACV was a big company, they were hiring back a lot of really, really qualified software engineers from Google and Facebook and other places in the Bay Area who had grown up in Buffalo, really wanted to come back and live there, and you know, and just hadn't found a compelling job opportunity that they were really excited about in terms of like high growth startups. And so that to me is we haven't seen that in other. We've got companies in all sorts of other you know, places outside of major cities, and I haven't seen that type of pull. So there's something about the the loyalty to the Buffalo area, which is really strong, and to the extent that you can leverage that to recruit great talent back, I think that's awesome. And then I would say this, you know, having a little bit of the remote mindset in terms of just thinking about where your market exists is helpful. You know, even if you're not necessarily a remote company, but believing that your market could be anywhere. I mean, in the case of ACV, there was like, they were very much a local company. Like, we'll start, you know, we're going to start in Western New York, and then we'll expand geographically into all these different markets. And that's the nature of their business. But I think for B2B software, I think you have to think like we are serving the internet, and we are serving large companies anywhere, and whether we physically have the majority of our presence here in Buffalo or not, I think you probably need that mindset from day one.
Awesome. That's great feedback. I think that's so true with the internet as your customer, and you know, I think people are, even at least in our business, people are more tolerant of, you know, our team being remote. And even international markets, I think, were always a tricky thing where people are like, oh, we want someone local, time zone. We've even seen that change where Europe and Asia are like, hey, you know, your team's in the US or North America, that's totally fine. Just give us the support that we need to be successful. Your product really helps us. All right, so I'll stop sharing in 1 second, but just I will post this in the Western New York Community Slack channel. If you're not part of it, Google those 4 words and the sign up page will come up. The link is there, but that won't be useful if you don't have the deck, because that's where I'm going to share it. Mike and I are both on Twitter and LinkedIn and tend to be fairly active. I'm pretty active in the Slack channel as well. If you had questions you wanted to follow up, I'm happy to follow up after the fact. And we will come back to the questions. So Mike, I saw one in there around the rule of 40.
Yeah.
And the rule of 40 versus hyper growth models that I outlined with, the WOW model or the T2D3. Do you want to take that?
Sure. I think this is a good question because the rule of 40 is a well-known metric to strive for, and it is a really good metric of, this is a high quality, efficient company, and I think you'll see it most, mentioned or referred to in kind of public companies or near public companies at scale. You can maintain a rule of 40 score of 40 or better, you're like best in class, and valuations will, are the multiples that companies are valued at are really highly inflated for companies that maintain, plus rule of 40 efficiency. All that being said, it's a metric that doesn't scale down as well, and so I think we tend not to look at it as much for companies that are, below maybe 10 million of ARR. And the reason being that if you're growing really fast, you're growing 150, 200%, your EBITDA margin will get, your growth completely overpowers the EBITDA margin in that equation. And so you'll always have a great rule of 40 score in that case. And so I think that seems like where the question was going, which is, at what point is that a better metric? And I would say above, generally in the companies that we're looking at, it's somewhere above kind of 10 million of revenue. In the below that, we always look at really what John was alluding to, this metrics of net new ARR or net new run rate revenue if you're not an ARR business versus annual burn rate. And I think the way to think about that is like if you're adding $1 million of revenue or dollar of ARR for every dollar you're burning, investors look at that as a great trade-off. They say, like, I put $1 in, I'm going to get that whole dollar back within a year, and next year, assuming that their churn or net retention is solid, I'll get another $1 back. Maybe I'll get $1.20 if they've got net expansion. And so that if you were to just run out like a kind of IRR return rate on that looks fantastic. And it doesn't have to be exactly a 1-for-1. Even 1.5 to 1 is a pretty solid ratio. But I think that's what we look at more in those in the high growth, lower revenue category.
Awesome. Yeah, that's great feedback. I do think those stats Mike highlighted are extremely important for every founder or wannabe founder or soon to be founder or existing team to look at. Your revenue retention, the churn rate, your expansion profiles, and just really getting to the bottom of what a customer journey looks like post acquire and the lifetime of that customer. And if you can land a customer, it's far easier to grow that customer with you than it is to lose them and then go replace them. So I always hear about the leaky bucket, like you don't want your churn rate to be high, and even if you're growing super fast and that's replacing all your churn, you gotta fill the bucket, give people a reason to expand, give people a reason to stay. So there was a question around when to bring in product management position, and I think this is a really good question, and actually I think one we've been spending a lot of time on at Tackle. So in that cycle of product and kind of customer acquisition and then customer delight or product sales, customer success, in the early days, someone has to do product management. And I think a lot of times it's the founder, whoever's running the product team, engineering, it's the person with the vision who's running the product management team. But you get to a point where that starts to break down and your engineering team needs more kind of day-to-day product support versus strategic product support. And you want your kind of founding visionary to be able to spend more time thinking about where you're going and how you're scaling. For us, we ended up hiring our first product person around low 20 employees. And it was when the engineering team had grown to, you know, we organize our engineering team into pods. There's a tech lead manager and 3 or 4 engineers who make up a pod. When we had gotten to 2 pods, there was a lot of product management demand on our founder and CTO, and we were able to add a product manager to complement his skills from a strategic standpoint. I think, you know, that's a role that if I look back at, we should have brought in sooner. And you know, it's probably, especially if you're thinking of growing a meaningful engineering team, the sooner the better you get a product person engaged to understand the context and start to get feedback from your customers, the better.
I might just echo that. I would say the 2 like big responsibilities that we think of for most product managers are both the kind of the blocking and tackling of process stuff to make sure that products delivered on time and that they're kind of managing to make sure that the trains keep running on schedule. And the other piece would be and insight from customers and other data sources that you have to help inform the product roadmap going forward. And so at whatever point you feel like one or both of those is extended beyond the capacity of the existing probably product, probably the engineering or founding leader of the product team, that's the time when you usually make sure it makes sense to bring somebody in. And the other thing I would say is, like, more and more these days, particularly in the kind of bottoms up, really efficient types of companies that John has been speaking about, you know, we see them having some degree of product-led growth where they're doing less paid acquisition, less paid selling, and the product really speaks for itself. And that's kind of oftentimes what helps to spur some of this viral adoption or just really strong referrals. And so if that is part of your strategy, earlier always is better, because it's just even that much more critical to make sure that you are incorporating feedback quickly and really building a product that do that.
Awesome. Yeah. I mean, the product-led growth, if you're not a product-led growth company or you're building a product that doesn't follow product-led growth principles, because either it's a high-touch product or has a sophisticated buyer that might require customization, you can still learn a lot from the product-led growth patterns. So I think a lot of value in that concept. So I know there was a question around Launch New York, and I didn't mean to imply that any of the resources that are out there doing work to connect the community aren't doing amazing things. I think, you know, Buffalo Startup Week's an example of the amazing activities and events happening in the community. At least from my standpoint, in B2B SaaS, that was an area in the community. It took me a little bit to get engaged and find a way to other like-minded folks in the community that cared about B2B SaaS, you know, hypergrowth, capital efficiency. So that's an area that, like, the segmentation of the community over time is something I think we can continue to do better as we scale. So I'm just we're at 12:58, so want to keep the trains running on time. So one, thank you all for joining. Mike, thank you for joining and sharing your insights. And we'll share this in the Western New York Community Slack channel. Madonna, Kanishka.
Great.
Turn it back over to you.
Thanks, everyone.
Great. It was wonderful having you both. Thank you for knocking it out of the park. Right as we were getting started here with our keynote, John, Mike, you were fantastic. Really appreciate you coming on board. And I do repeat John's encouragement for everyone who's on this call who isn't already on the Western New York Startup channel, or excuse me, the Slack channel, to please take a minute to do that. Just outstanding content, guys. Loved your, as you referred to, John, as your collection of reflections. Fantastic points that I think can be extracted for companies that are at those very early stages, and then also as they scale and grow. So many resources that you both brought up and to be able to take advantage of. So really appreciate you being here. Outstanding job. Thank you.
Thanks, everyone. Have a great one.
Thank you.
Thanks, guys.
Bye.
See ya.